Hi, this is the RITE Report, and I am your host, Chris Angle. I'm the author of 4 books on philosophy, one of which is The Philosophical Equations of Economics. Along with me is my colleague and co-host, Rick Samuelson. Rick graduated from Yale, has an MBA from Wharton and also from Tufts, and Rick is an independent venture capitalist. And approximately once a month we put out a report on the state of the economy and the stock market. And this program uses as its basis the RITE Report, which can be seen at www.stock-market-direction.net. And it's a natural outcome of my book that I just mentioned. First, the RITE Report generates indices from the monthly compilation of corporate, business, economic, and political news, and has especially ones that have a directional bias inherent in the headlines. And these are used as indices for use as factors in prognostication of the market direction. And if you'd like to comment about the program, give us a shout at the.rite.report@gmail.com. the.rite.report@gmail.com. So let's get it underway here, and let's go right to the current RITE report and start out with the macroeconomic snippets. And the U.S. Census reports that after-tax profits for retail corporations was down 5.6 billion, and manufacturing corporations tax profits were down 38.8 billion from the fourth quarter, and the April 2020 sales of merchant wholesalers where it was down 16.9%. Real average earnings decreased 0.9% over the month in May, and the estimate of U.S. selected services total revenue for the first quarter of 2020 was a decrease of 2.9%. U.S. total business end of month inventories was down. U.S. total business sales were down 14.4%, and from the Conference Board, GPS data from cell phones show that government mandate restrictions on physical movement at the height of the COVID-19 pandemic caused a steep decline in trips to retail stores and recreation venues of between 40 to 90%. And in social distancing measures to counter the pandemic in the Netherlands have led to an unprecedented decline in economic activity of between 10 and 15%. Under this base scenario, which assumes moderate recovery, GDP would decrease by 6% in 2020, followed by an increase of 3% next year. Labor productivity put out by the Bureau of Labor Standards decreased in 54 of 86 categories, and more than half the industries with declining productivity had growth in hours coupled with declining output. From the CPB, it's a World Trade Monitor, shows a decline in world trade volume in April of 12.1%. Real gross domestic product decreased 5%. And let's see, and recent research from the Conference Board found that 9% of surveyed U.S. organizations had conducted permanent layoffs. However, more than double that number, 16% of the organizations are planning to conduct permanent layoffs by the end of July. Total personal income decreased 4.2% in May from the Bureau of Economic Analysis. Total construction activity for May was 2.1% down. And so we had about 14 total negative business and economic snippets. And the positive snippets were a little bit improved from last month. The Conference Board Employment Trends Index, following sharp declines in March and April, now stands at 46.28, up from 42.53. However, the index is down 57.9% from a year ago. Real average weekly earnings increased 0.5% over the month, and end of month inventories up 0.3% from last month. U.S. retail and food services sales got an increase of 17.7%. Sales of new single-family houses were up 16.6%. That's kind of amazing. New orders for manufactured durable goods in May increased 15.8%. Consumer spending increased 8.2%. New orders for manufactured goods increased 8%. Total non-farm payroll employment rose by 4.8 million in June, and the unemployment rate fell to 11.1%. And so there's seeing some improvements there. And the CBO said that the U.S. economy is poised for real GDP growth at an annualized rate of 12.4% in the second half of 2020. The Conference Board Consumer Confidence Index recovered somewhat in June, but still remains below its pre-pandemic levels. So total snippets there were 11. And then we go to our economic analysis and indicator summary. High yield bonds went down, so that means their coupon rate went up. And the iShares select dividends went down quite a bit, actually, over 1 month, from 89 to 80. The Purchasing Manager Index indicated 52.6%, which means the economy is expanding. The IHS Purchasing Manager Index was at 49.8. Now that's up. The economy is not expanding much yet, but it's better than last month. Construction spending was estimated in a seasonally adjusted rate of 2.1% below April's estimate. So that's a negative. From the Bureau of Labor Standards, unemployment rate decreased to 11.1%, positive. Civilian labor force participation rate increased to 61.5%, that's positive. The employment population ratio increased to 54.6%, positive. And the Employment Trends Index from the Conference Board increased, so positive all around there. Productivity decreased 0.9% in the non-farm business sector. Output decreased 6.5%. Manufacturing increased 0.3%. Okay, got a positive. Output decreased 6.9%. Overall, we got to put that as in the negative category. U.S. manufacturing corporations seasonally adjusted after-tax profits were down, and advanced estimates of U.S. retail and food services sales for May was an increase of 17.7%. And the combined value of distributive trade sales and manufacturers' shipments for April was down 14.4%, and the industrial production index put out by the Federal Reserve of St. Louis showed a downtick to 92.5503. Year over year, it's still positive, though, amazingly. And the velocity of money also downticked in the first quarter. Privately owned housing units is at 14.4% above April's rate. So that's a positive. And the Conference Board leading economic indicators increased, and the coincident economic indicators increased. And sales of new single-family houses is 16.6% above the April rate, positive. And new orders for manufactured durable goods was up 15.8%. Pretty good. Existing home sales by the National Association of Realtors indicated down 9.7%. And the real GDP, of course, is at negative 5%. Personal consumption expenditures, however, went up 8.2%. Personal income down 4.2%. Consumer confidence index increased. That was put out by the Conference Board. The restaurant performance index was up. And the corporate profits decreased to $295 billion in the first quarter. New orders for manufactured goods in May was up, following 2 consecutive monthly decreases. It increased 8%. And the CPB showed a decline in world trade, as we mentioned above. Okay, so positive, 13 indicators positive, 13 negative, and 0 neutral. So now we're going to go over the overall situation. And domestic political risk is probably the Chinese virus has increased political risk. The tax risk is still, corporate taxes have been cut, so that's great. Individual incentive regulations are decreasing, and government is making a large investment into viral research, so production of knowledge, we're going to give that a positive 8. Technical analysis of the markets showed a reversal from the downtrend in the early spring from the Chinese coronavirus, but now it shows that markets are up, and so we give that a +5. And the negative snippets are still overpowering the positive, so we're going to give that a negative. And economic indicators are still, they've rebounded somewhat from 9 positive last month to 13 positive. It's just about equal, so we're still going to give that a -3. So our total here is 25, and we're going to give the RITE Strategy Index is improved slightly to 67.9%. A little bit up from last month. And so we're going to give the market conclusion now. And last month, the RITE Report stated that the economy is no longer degenerating due to the China coronavirus. And this is true, as the RITE Report strategy is improving, reflecting this. However, the RITE Report had a sudden mid-month temporary call to go to cash, where there was an onslaught of news about the second wave of the COVID-19, and there's still quite a bit of news about that. But that news, I think, has subsided as deaths due to the virus are going lower. So we're going to think that the states are going to stay open, because the deaths haven't really consistently reversed itself and gone upward. Therefore, we're going to say that the market will continue to advance incrementally, and so go long and stay long. So enough of that report. Let's go to Rick and see what he thinks. What do you think about the state of the stock market and the economy, Rick?
I concur. Stay along. I think in tech, some of the valuations are looking kind of stretched. So it's not clear to me that in tech particularly, you're going to see other than some volatility there. I think the weight of money from the Fed is such that we could go significantly higher and valuations could be more stretched, but periodically negative news, whether it's about COVID or China or something else, could whack the tech stocks quite hard from time to time. So you're going to be dealing with I think a more volatile environment as we've seen in recent months, and so none of that is surprising. You just have to strap on your seatbelt. I think longer term, there are actually some very encouraging things going on across industry. One of the encouraging things is that even though it's not clear from the productivity statistics yet, I think we're going to see huge advances in productivity going forward. Obviously, that's going to happen first in service businesses, where people can effectively continue working online and get most of what they need to get done. That's occurring across IT. It's occurring across other types of services, legal, accounting, and so forth. But I think even with manufacturing, the conditions of the COVID pandemic are forcing manufacturing companies to operate with fewer staff. That's just a fact. And numerous measures are being taken to ensure that production volume returns to normal as quickly as possible. And that will include for the use of robotics, that will include rationalization of the workforce. You're reading now of many companies that are using this opportunity to lay off staff that were kind of marginal, but this provides the perfect opportunity to either furlough or lay them off and achieve ultimately higher productivity levels. So that's going to feed through to earnings over time, hasn't yet. So I would think you'll see 2021 earnings in selected sectors improve dramatically. Now, mind you, I'm not sure airlines, hotels, and other types of services that have been drastically affected by the virus are going to return to normal conditions in the foreseeable future. There just won't need to be as many business meetings in person. There just won't need to be as much business travel in person. There just won't need to be as much entertainment related, travel related, holiday related activity in the future for quite some time. So I expect to see a pretty bifurcated outcome in the coming months and indeed years. Certain sectors, oil and gas, will continue to suffer. There won't be as much need to commute. This will eventually come back with population growth, with the rest of the world catching up economically. Demand for oil in China and elsewhere will continue to grow. But certainly within the United States, different behavioral patterns affecting business are going to make for long-term changes affecting industries in a very different way and at a very profound level. Much of it good, much of it skewing productivity higher, but with industries that originally catered to having people meet face to face, they're going to be continuing problems.
Mm-hmm. Hey, you mentioned, so you kind of mentioned a point about efficiency within the economy. So really, there are some good points being produced by the pandemic presently, in the sense that it's producing greater efficiency within the economy. Is that right?
Yes. Well, I would offer this caveat, though. I think we are going to be faced with long-term structural unemployment for people that were in those sectors of the economy that have been, shall we say, semi-permanently affected, whether you're an oil worker or whether you're working in a hotel or whether you work for an airline. Redeploying these people and other jobs is going to take quite a bit of time, and some of them may never find jobs outside of their career industries.
So you also think that there are certain sectors that are going to be hit hard in the long term, such as maybe commercial real estate? What do you think about a sector such as that?
Yes. Retail stores may never recover the volumes they once saw. We saw Brooks Brothers is filing for bankruptcy, as well as a bunch of other retail stores. I think you're going to see more of that, though. Redeploying many of those workers will not be easy. There are many people that work their whole lives in retail, and there just isn't going to be the demand for malls. There isn't going to be the demand for retail shops for a very, very long time. So I think commercial real estate is going to remain depressed for the foreseeable future.
So for the next 30, 60 days, what do you feel that an investor should do? Stay positive in the market, or what?
Yeah, I'm invested in tech, and I'm sitting pat, and I'm happy to ride the volatility.
And so a good investment would be, say, the NASDAQ 100?
Yes.
Okay. Okay, Rick,
Yes.
Thank you for that, and we'll see everybody next month on another edition of the RITE Report.
Thank you.